Okay, looks like we're live. Good afternoon, everyone. Welcome to another virtual event of the Bastiat Society of Washington, D.C. My name is Steve Dewey. I'm the chapter director for our Washington, D.C. chapter. The Bastiat Society is the public outreach program of the American Institute for Economic Research, otherwise known as AIER. We promote the principles of free market economics, sound money, limited government, personal liberty, and a free society. If you would like to learn more about AIER and the Bastiat Society, our website address is aier.org. For our event today, I'm very honored and excited to have Steve Hanke as our featured speaker. He will be speaking on the topic of COVID-19 lockdowns and their ratchet effect of increasing government control and their economic impact. Since the COVID-19 pandemic hit in the United States in March of 2020, federal and state governments have responded with varying levels of new and prolonged restrictions on human activity, as well as unprecedented deficit spending by the federal government and money creation by the Federal Reserve. Professor Hanke will examine the impact of the COVID-19 lockdowns across the United States over the past 15 months and how they have exacerbated the ratchet effect of ever-increasing government activity and control over our lives. A little bit about Dr. Hanke. I must say he has just an incredibly impressive background. I'll just take a minute to summarize very quickly his impressive background. He is a professor of applied economics and founder and co-director of the Institute for Applied Economics, Global Health, and the Study of Business Enterprise at the Johns Hopkins University in Baltimore. He is also Senior Fellow and Director of the Troubled Currencies Project at the Cato Institute in Washington, D.C. He's also a Senior Advisor at the Renmin University of China's International Monetary Research Institute in Beijing. He's a Special Counselor to the Center for Financial Stability in New York, a contributing editor at Central Banking in London, and a contributor at the National Review. Professor Hanke is also a member of the Charter Council of the Society of Economic Measurement and of Euromoney Country Risks Experts Panel. Professor Hanke served as a senior economist on President Ronald Reagan's Council of Economic Advisors from 1981 to 1982, and a senior advisor to the Joint Economic Committee of the U.S. Congress from 1984 to 1988. He's been an advisor to 5 foreign heads of state and 5 foreign cabinet ministers and held a cabinet level rank in both Lithuania and Montenegro. He has been awarded 7 honorary doctorate degrees and is an honorary professor at 4 foreign institutions. In 1988, he was named one of the 25 most influential people in the world by the World Trade magazine. Professor Hanke earned both his bachelor's degree and his PhD degree in economics from the University of Colorado. So before we get started with our discussion, please note that our event is scheduled for 75 minutes until 2:15 p.m. and we will reserve approximately 30 minutes at the end for a Q&A session with attendees. If you have a question that you would like to ask, please submit them using the Q&A button at the bottom of the Zoom screen. So to start off the discussion, I would like to ask Professor Hanke to comment on this concept of the ratchet effect, which basically means that whenever government imposes new temporary government powers to respond to an emergency, those temporary powers usually become permanent powers. So Dr. Hanke, please proceed with your thoughts on the ratchet effect.
Thank you, Steve, for that introduction. It's obviously a pleasure to be addressing the Bastiat Society, Bastiat being one of the great Frenchmen and classical liberals who could clearly see through things and and you get to a punchy bottom line. He was, of course, the master of rhetoric and polemics. Now, the Ratchet Effect has been around actually for quite some time, but the person who's done the most work on it in kind of the modern sense is Bob Higgs. Higgs has done a lot of work on it, and actually, Bob and I even wrote a piece in the Financial Times on the Ratchet Effect years ago. The Ratchet Effect is, in simple terms, is the following. The government never lets any crisis go to waste. They always jump in and try to solve or mitigate the crisis. And the problem is, whatever they're doing, whether it works or not initially, it never goes away. So that's the ratchet. Every single crisis stimulates the government entrepreneurial class and the political class to do what? Reach for the checkbook primarily, and secondarily to institute new laws, invent new agencies, new bureaus, and so forth to deal with whatever the impending or alleged crisis happens to be. And that these institutions, as well as the checkbook, tend to be permanent. And if you look at the current administration, for example, the first few months of the Biden administration, what have we had? We've had 1.9 trillion in COVID relief that's been passed, by the way. 2 trillion proposed for so-called infrastructure programs, 1.8 trillion for family benefits, a total of $5.7 trillion. Now, the problem with this is, if you look at it analytically, people say, well, 5 trillion, you know, that's really opening the checkbook. I mean, we've never seen anything like that to deal with a crisis before. But that's just the tip of the iceberg, because those are really fake costs in a sense, because to raise $1 in tax revenue, there are costs associated with the raising of those funds. For one thing, you've got two hidden costs, and the hidden costs are, one, the extraction cost associated with the IRS having to raise the revenues to fund those expenditures. And we know this is the case, by the way, because President Biden has already proposed that the budget of the IRS be increased by $80 billion so that they can, in fact, pluck the goose and raise the revenue to fund these programs that he's proposing, these three big programs. So that's one cost, one hidden cost. The other hidden cost is the compliance cost associated with the taxpayers themselves, who have to, at a minimum, fill out their tax forms and write a check to the government. But it's more than that, because they hire lawyers, they hire accountants, they spend a lot of their own time getting their records in order and in fact complying with the tax laws. So if you look at those two hidden costs, that's about ranges from 10 to 25 cents per dollar of every tax dollar collected. But that's just the start of it. There's something called the excess burden, and the excess burden is associated with the tax disincentives and distortions that are thrown into the economy because you're raising taxes at the margin. And as a result of that, national income is in fact reduced. This is really an application of good old-fashioned supply side economics. And those costs are very significant. The two studies that I like that deal with excess burden are, one was done by Martin Feldstein, late Martin Feldstein. The other was done by late Bill Niskin, and they come to about $3 excess burden or damage to the economy, if you will, associated with each additional dollar of tax revenue that is raised. Now that puts us at, let's just say a rule of thumb would be $3. So for each dollar of tax revenue raised, in fact, you've got to multiply that by 3 to get the real cost associated with those government expenditures. So if we multiply the 5.7 trillion that have been proposed by Biden, what do we get? We get 17.1 trillion. So we're talking about a big number. I mean, that's roughly 80% of last year's GDP. So the cost of these things, if you actually look at the hidden cost and excess burden, you're up to, very big numbers. So that's basically the start of the ratchet. And putting it in a contemporary setting, you see what's involved. Now, these are not going to go away, by the way. Once the government programs start, they will continue churning away. And as Higgs has documented in some of his books, many of the programs that were started in the Great Depression, and they were alleged to be temporary programs, we still have them. They're all, none of them have gone away. I mean, you name one government program that's axed. We're not talking about a profit and loss system where, you start making buggy whips and the demand for buggy whips goes down, and pretty soon the profits disappear, and pretty soon the manufacturers of buggy whips are long gone. That is not the case when you're dealing with the public sector and the government. I would add that the cost that I've just given you, jacking that 5.7 up to 17.1 trillion, is probably a gross understatement, because the infrastructure part of the program is usually associated with huge cost overruns. The studies that have been done on this indicate that the cost overruns for public infrastructure projects run about 50% to 100% over their advertised cost. So that's another big increase. They're also plagued with huge delays. So again, in the public sector, you're dealing not in a private profit and loss setup, but you're dealing with something where they do a benefit cost study, and they say, oh, the benefits are going to be greater than the cost. Number one, the benefit cost studies are usually tweaked and biased all over the place. But even assuming they were right, we don't know if they're right, because there are no ex post studies of those government investments that have been made based and justified by a benefit cost study. So you do the benefit cost study, they say the benefits are greater than the cost. Well, if you multiply the cost by 3, that excess burden aspect, you're gonna, I can't imagine that there are many government projects that actually would pass any kind of a benefit cost smell test. But the big problem is we don't even know how these things perform, because we're not in a private business where at the end of the year, either you've made a profit or a loss. And if you've made the right choices, the right investments, and deployed capital appropriately, you're going to make a profit. If not, you're going to make a loss. And if you make too many losses, you're out of there and long gone. So that's basically about all I have to say initially, at least, about the ratchet effect. Now, you could say, well, if no projects are really justified, if you're multiplying the the cost of government spending by 3 to appropriately indicate the cost of raising government revenue. What should the size, that implies that the size of the government's way too big. And if you go back, Milton Friedman used to always say that he thought he'd be pretty comfortable if the size of the US federal government was about 10 to 15% of GDP. And if you look at these numbers on excess burden and crank it out, and Bill Niskanen actually has done this in one of his books, one of the last books he wrote actually before he passed away, you end up with the question is, well, what is the optimal size of the government? Given if you do the sharp pencil work that Niskanen's done, for example, on excess burden, well, it is about 10 or 15% of GDP for the size of the federal government. If the size of the federal government was 10 or 15% of GDP, believe me, the excess burden wouldn't be $3 for each dollar of tax revenue raised. It would be a lot less. And you would actually find at that lower level of government activity, you probably would find things that could be justified on a benefit cost basis. So I think with that, Steve, I've probably said enough on the Ratchet, and I would refer again to Higgs's work. That's the really gold standard when it comes to the Ratchet effect. He's one of the few economists who actually can write as well as Bastiat could write. So you can read it, understand what Higgs is talking about.
Yeah, now the Robert Higgs book that explained the Ratchet effect, the title of that book is Crisis and the Leviathan. And correct me if I'm wrong, but was that first published in like 1987?
I can't really remember the publication date. Something like that. I mean, I have it over here. On my bookshelf. I could run over and get it and tell you. But yeah, if you want me to, I will. Actually, it's literally right over 3 feet.
No, okay. Yeah, no, that's okay. But that's just for the benefit of our attendees. That is the title of the book that discusses the Ratchet effect. It's entitled Crisis and the Leviathan by Robert Higgs.
You can get most of Higgs's works, by the way. The Independent Institute in Oakland, California, where Higgs was a senior fellow and editor for many years of the Independent Review. Just go to the Independent Institute website. You'll find all this material.
Right. So the next thing I wanted to get your thoughts on is the Federal Reserve's activities that took place after the pandemic hit, after the COVID-19 pandemic hit the United States in March of 2020. It really caused the Federal Reserve to launch into really unprecedented activity. And I was surprised to learn even just recently how many funding facilities that they created as a result of COVID-19. I thought it was like 6 or 7 or 8 new funding facilities. It was actually 13. That is really unprecedented, and that kind of ties in with this concept of the Ratchet effect, where when there's an emergency, the federal government just creates this reaction to an emergency. But I wonder if you could talk a little bit about the Federal Reserve's actions resulting from the COVID-19 pandemic, and in particular the growth in the money supply. So as the M2 money supply growth has been also unprecedented. I think for example, from March of 2000, I think it was from April of 2020 to April of 2021, M2 money supply growth was 24%, which I believe is unprecedented.
Yeah, Steve, I just stepped away. I was going to go to my desk and get some notes, but let me go through the Fed a little bit. Of course, the ratchet does come in here, and it's so obvious because the broadest measure of the money supply that the Fed provides is M2. That money supply metric. If you want to get a better metric and broader picture, go to the Center for Financial Stability, because they have M4 and they have it in divisia terms. Professor Bill Barnett is the guru on this, and those are the best data, actually, the Center for Financial Stability. And a broad measure of money is the best measure of money if you're trying to chart the course of nominal GDP, which of course contains a real component and an inflation component. So we're back to the equation of exchange and monetarism, and the equation of exchange, M, the money supply, whatever measure you're using. I'm going to talk, I'll talk in terms of M2 because it's easy to get, and the Fed produces that measure. So M times V, the velocity, equals P times Y if you use the income form of the equation of exchange, where P is the price level and Y is real GDP. So what you've had is an explosion in M, and the ratchet, all these new programs and so forth, and it has been unprecedented. The last 17 months, the annual average rate of growth in M2 has been slightly over 20%, and which we haven't seen that since 1943. 1943, remember, we did have a crisis then. We were in World War II, so we go way back to see anything like this. It's really completely unprecedented. So if you look at the velocities and the inflation target of the Fed is 2%, and you play around with the arithmetic, you end up with what I call the golden growth rate for the money supply. If you wanted to hit the inflation target of 2% that the Fed has, they should have been growing the money supply at around 7%, 7 to 8%, let's just say roughly. So they've been growing on an annual basis, not of 7 to 8% per annum, but a little over 20%. So it's way over double the golden growth rate. So we know this is an unprecedented goosing of the money supply, a ratcheting up, if you will, of the money supply. Now, what does that lead to? Well, the first thing that anyone that has studied Milton Friedman and knows monetarism and monetary economics, the first thing that happens with an injection like that is that asset prices go up. Now, there's a lag of about 1 to 6 months. And so why have they gone up? Of course they've gone up. Look at the stock market. I mean, not today, but look at what's happened to the stock market. Look what's happened to housing prices. Look what's happened to other real asset prices. They've gone zooming up. Then the next thing that occurs, the next stage after the injection, with a lag of 6 to 12 months, is the real economy starts cranking up. So look at the real economy now. The Atlanta Fed, which has a pretty accurate and good record and technique for estimating real growth, they're indicating that in the second quarter, given the second quarter data, that we're going to be growing in real terms 10.5%. I mean, this is almost unprecedented. So the real economy has really taken off. And if you look at like retail sales are on a the last 3 months, the data indicate that on an annualized basis, that last 3 months, you've had like a 50.5% increase in retail sales and sales for food services. So that you just never seen numbers like that. I mean, they're just to the moon almost. And the last thing that happens with a lag of about 12 to 24 months is that actual real inflation sets in. So at present, the Fed is trying to manage our inflation expectations, and they say keep them anchored. And they do that by saying, well, the recent numbers we've seen it's just a transitory effect. They're going to be going away pretty soon, and inflation will come down, and we'll be meeting our target and everything. Well, if you look at use a monetarist model for national income determination, it's not going away. It's actually going to be coming. So in 2022, you'll have, I think, you'll end up with inflation a little under 5% per annum using the monetarist model. And 23 and 24, you'll have it a little under 6% at least. And that's all baked in the cake, because we already know that for 17 months, we've had this extraordinary increase in the money supply measured by M2 of over 20%. So this is all, it's just arithmetic. I mean, there's all the debate in the paper and everything is essentially irrelevant, because my 95% rule, remember, holds, and that is 95% of what you read in the financial press is either wrong or irrelevant. And the temporary thing, there is a temporary aspect, by the way. There are two things going on. They say, well, there's this base effect. A year ago, the inflation had been, really punched down, and the price indices were very low. So any calculation you make today about year-over-year increases or changes in prices will be distorted because of this base effect. They'll be by, just do the arithmetic, and you operate off an artificially low base, and you get an artificially high percentage change. It's true. That base effect will be gone in another 2 months, by the way. So that is a transitory thing. There is another transitory aspect, and that is the real economy. As I indicated, after this monetary goosing, the real economy is roaring now in terms of demand. The demand is huge right now for most things. And due to COVID disruptions and logistical problems and supply chains and whatnot, the startup on the supply side is lagged in some sectors. And as a result of that, if demand is going to the moon and supply is lagging, well, you have something called supply and demand curves, and where they will cross at a higher price than they would have if supply would have been flexible and been able to accommodate the big surge in demand. But that will settle down too. So the Fed does have an argument. The Keynesians, who they latch on to this transitory thing. There's something to it, but behind it, we're going to have a huge wall of inflation that's stimulated and in the pipeline because of this monetary injection we've seen. And that's been, again, if to use our theme of the day, it's been ratcheted up. Now the Fed, by the way, the Fed won't be quite like government spending. The government spending will be a ratchet, but the Fed will ultimately pivot and start tightening up. So that won't be. We're permanently not going to see the Fed. We're not in Venezuela or Zimbabwe or someplace where in fact you had monetary ratchets, and as a result you've had in 62 cases in world history where you've had hyperinflation. So the monthly inflation has been over 50%. That's only happened 62 times in world history that we've had episodes of hyperinflation. Now, that is where you get a ratchet in the money supply, by the way. So those are very, very unusual. The money supply usually doesn't end up ratcheting up as government expenditures do. So government expenditures adhere to the ratchet, but the monetary policy usually does not. It's very rare that it does.
I have a follow-up question on the M4 money supply that you mentioned. You mentioned the Center for Financial Stability, that you look at their data rather than the Fed's data. Is there a reason you look at the Center for Financial Stability data, and
Well,
where do they get their data?
Well, there are two reasons. One, the overarching reason is that the quality of the data are just much better. And quite frankly, Professor Barnett knows a lot more about this than anyone at the Fed. But beyond that, there are two technical reasons. One is that M4 is a broader measure than M2. It includes more things. There are 10 things that are included in M4, and M2 has a much smaller coverage. So you want to include everything in your metric for money supply that has moneyness in it, that's close to money. Now, the second reason is that this is aggregation theory is used in the numbers that come out of the Center for Financial Stability, this Divisia aggregation. And that is all the 10 components in the money supply measure have weights associated with them. So currency is in there. Currency receives 100% weight because it's money. I mean, you can use it instantly for a transaction. If you go way out to the last thing in M4 are T-bills. Now, T-bills aren't exactly money, but they have a lot of moneyness associated with them, especially at very low interest rates. They're almost like money because you're indifferent. If you're not getting paid any interest on a T-bill, it's not very sticky in your pocket. And if you want to buy a house or something and you've got a bunch of T-bills, what do? You exchange those for US dollars, and it either goes into, you're not going to get a huge pile of cash. You'll probably have most of it go into your checking account, which also receives 100% weight in terms of moneyness. So the Divisia thing weighs the various components in there, and it changes around. The weights change around depending on the opportunity cost associated with switching out of whatever is the component into actual cash. So if interest rates are real high, for example, like they were in the late 70s and early 1980s, you end up with very high interest rates. And that means that money market funds and T-bills and things like that don't have very much moneyness in them because they're sticky. You want to keep them in earning a high rate of interest, and you're very reluctant to actually cash out of those things into greenbacks that you can actually spend in the store for transactions. So that's the basic idea. Now M2, all of the Fed things are not divisia. They have no weights whatsoever. They're what's called simple sum aggregations. You just add up whatever you add currency, you add demand deposits, you add whatever the components are, and that's it. You don't weigh them in any way. So the divisia is a more sophisticated and much superior handle on this. If we go back, by the way, a great example of how you can get messed up with this, Paul Volcker, when he was chairman of the Fed, of course, he came in as chairman in 1979. We had tremendous inflation and very high nominal interest rates. And he latched onto the monetarist idea. He said, I'm going to crush inflation, and I'm going to do that by slowing down the rate of growth in the money supply. And they were looking at M2 at the time, and Volcker thought that in fact he had the golden growth rate just about right, and he was looking at the Fed's simple sum. But if you looked at the Vizia, which Barnett was calculating at the time, actually you ended up with the squeeze that Volcker was putting on was much more severe than actually he thought it was. Because if you looked at the Vizia numbers, they were crashing much more than the simple sum numbers. And the reason why they were crashing much more is this proper weighting due to interest rates and the very high interest rates on like money market funds and so forth. So he didn't have the right measure of money supply on his speedometer. That's why it's important for monetary policy purposes. You've got to have the right metric on your dashboard, and if you don't, you can make mistakes. So he had the right theory, the right principles. Volcker did. He didn't have the right measurement metrics on his dashboard, and as a result, remember we had two recessions in 1981 and 83 when he was putting the squeeze on. If he would have had the right metric on, we would have had maybe not even two recessions, and they would have been obviously much milder than what we experienced, because he was stepping on the brakes a lot harder in reality than he thought he was.
Okay, good explanation. Very, we could go on that much in greater detail, but shifting over to fiscal policy, you mentioned that maybe a more important ratchet effect was really the fiscal policy and the federal debt. So right now, the U.S. national debt is up to somewhere around $28 trillion. And I believe I calculated that it's, I think it's over 120% of GDP, which is even higher than what it was in 1945 at the end of World War II. So I was wondering if you could maybe talk about, just this tremendous increase in our deficit spending and our national debt.
Yeah, this gets a little bit into what I call lying prices, which goes back to the excess burden thing. The lying price is that the bottom line for these three programs that President Biden has proposed, at one of them, which is passed, actually the COVID emergency bill, this is a lying price. It's not 5.7 trillion, it's 17.1 trillion. So it's a lying price. And as a result of that, the taxpayer, the voter, he's seeing a price in the window, but when he walks in the store and actually experiences what's going on, he's going to get clobbered with something that's 3 times higher than the advertised price on the window. So as a result, people are less concerned, shall we say, because the price they see is much lower than the actual real cost once you include the excess burden. Now that's the same with the debt to GDP as it is with the fiscal deficit. The fiscal deficit, we have a clear lying price, of these government expenditures. We also have a lying price in terms of the debt itself, because if you go back to the early work Jim Buchanan did, there was a big debate at one point in public finances, and especially the Keynesians had all kinds of arguments that, in short, don't worry about the debt, to keep it simple. And Buchanan's early work, what really made him famous in public finance before he got it really directly, before they invented public choice theory, is the burden of the debt. And Buchanan demonstrated that essentially the classical economists and people like Bastiat were right, and that is that the future generations or someone in the future will pay for the debt because they will have to pay taxes to either amortize the debt or retire the debt, one of the two. So this is a lying price in the sense that current participants in the democratic process are not going to be the ones paying for this. So they're much more relaxed about it because, you know, if they're going to pay now and they're going to ratchet up now, and I know I'm not going to have to pay for it. I mean, you know, why not vote for it? I mean, it's no big deal. I'm not going to pay for it. Well, Buchanan's work all indicated that was the case, and that the burden where it would fall. So it's a very serious ethical problem. I mean, running a huge debt like this is basically unethical because today the voters and the politicians are making a determination about the burden, and they exchange that the people who aren't even born yet are actually going to be mandated to engage in this. This won't be a free transaction for them. They're gonna have to pay up whether they like it or not. So this is a problem with the debt. It all goes back to Buchanan, actually. And I can't remember when Jim did that work. He was actually still at the University of Virginia, so it was a long time ago. It was I think in the late 60s and early 70s, most of that work that Jim did on public finance. He actually wrote a book, I think, called The Public Finances. I have it down in the office. And Steve, don't ask me what the date of publication is on that. I can't really remember. But Buchanan is a guy. If you get into this public debt, he's the one who worked it all out. And I would say that was the start of a fabulous career, and which ultimately ended up with a Nobel Prize. But that's another story.
Yeah. One other comment I'll make about U.S. government debt, and this, I find it interesting that it's almost never discussed by anybody, and that is the U.S. government's unfunded payment obligations, which includes Social Security, Medicare, Medicaid, federal pensions. And there's varying estimates of what that number is, but it seems to be somewhere north of $150 trillion. And
that again is a lying price. You see, it's off budget.
Yeah,
I mean, they're under liability. So all of these things with the government, you always have a lying price. You don't have a market, so there is no market price. And any way you cut it, let's talk about a government highway going a public highway, the Beltway. You have to drive. You're down in Arlington. You're driving around in the Beltway, and massive congestion down there. That's not priced. That's a lying price. The delay that you and congestion that you have to suffer. I mean, yeah, you have to suffer it. It is an opportunity cost. You're sitting there on the Beltway, burning up time and gasoline and everything else. But there is no price on that, no direct price. And you end up with the same thing. People complain about, oh, we're running out of water. We got a water shortage someplace. California has a big water shortage right now. Why? Because lying prices. There's not a market clearing price. There's not a market for water. If there was a good market for water and good established property rights that were clear and unambiguous, what would happen? Well, the price would be going up now. And by definition, if you have a market, you can't have a shortage. The market's always in equilibrium. If you have a well-functioning market, it's in equilibrium. So there aren't shortages. There can't be by definition.
Okay, so I think we'll move on to Q&A with our attendees, and I have one question right off the bat. This was actually emailed to me yesterday by my good friend and deputy director of our Washington, D.C. chapter of the Bastiat Society, Jim Bond. And Steve, you might be interested to know that Jim actually works at the Federal Reserve Bank of Boston and is actually, he's going to be retiring from there in August. So anyway, Jim is a very smart guy who knows his economics, and he has the following comment and question for you. He says, my suspicion is that as a result of the big budget deficits that the Federal Reserve is going to put the pedal to the metal on monetary policy, that we are going to see interest rates below the rate of inflation for a long time. The CPI is above the 90-day Treasury rate for the next 10 years and above the 10-year Treasury for the next 5 years. That is a lot of financial repression. This is particularly serious for young people that are starting to invest and small savers. I think that this is not only bad for the economy, but it's going to increase wealth inequality and lead to broader discord within society. I'd like to ask Professor Hanke about the likelihood of an extended period of financial repression and the likelihood that financial repression will lead to a market crash and or sharp decline in the dollar. If so, what would he recommend that investors do?
Okay, Jim, this gets into an interesting thing. Milton Friedman used to always say one of the worst indicators of monetary policy stance is interest rates. And if you read the paper today, this again is my 95% rule. All the papers are only talking about interest rates. They're not talking about the money supply. The money supply is the only thing that counts. Forget interest rates. As Friedman told us and taught us a long time ago, interest rates are a very bad indicator for the, shall we say, temper and tone of monetary policy, whether it's loose or whether it's tight. Now, let me explain what this is all about. If the monetary policy loosens up, that means the money supply cranks up. What happens? The initial thing is that interest rates do go down. So that kind of follows everyone's intuitive knee-jerk reaction. Oh yeah, they've loosened up monetary policy. Look, interest rates are going down. And as Jim said, they're going to be, maybe implying that they could even be negative, or negative certainly in real terms. But what happens? If the money supply is goosed, and you look at interest rates, and this is why they're a bad indicator for monetary policy, and you should essentially forget them. Just look at the money supply. They go down. But then what happens? Pretty soon, remember, after the 12 to 24-month lag that I mentioned earlier, inflation kicks in. And when inflation kicks in, and Irving Fisher, actually, the great American economist of the 19th century, early 20th century, Fisher told us, and all of his empirical work showed, that interest rates follow inflation. So you loosen up, you goose the money supply, interest rates go down, and then after 12 or 24 months, inflation starts picking up, and interest rates follow inflation. So interest rates are going up. That's what's going to happen. So and in terms of the markets, it's obvious. Everyone is into the long bond now, and the bond markets aren't too. They think inflation is going to be transitory and temporary. but they're gonna be in for a shock, because as the real inflation comes in and hits us, interest rates will go up. That means bond prices will go down. It also means that the multiples in the stock market are going to go down. So eventually, as the real inflation kicks in late 22, 23, 24, interest rates are going up, bond prices are going down, stock multiples down, and the commodity prices will still remain strong. I mean, house prices will remain strong, real assets strong.
Okay, we have another question here from Jim Lordeman. Jim is actually the chapter director for our Nashville, Tennessee chapter of the Bastiat Society. Jim, thanks for being here. Jim's question is the Fed.
Got a lot of Jims in here. This is easy. Of course, we got two Steves to start the thing.
That's right. So Jim's question is, the Fed rapidly increased M2 in 2008 recession, and we did not get much inflation, apparently because interest on excess reserves was set high by the Fed, so banks parked their excess reserves. Will the Fed do the same thing now? Actually, Richard Salzman, Steve, I'm sure you know Richard Salzman.
Yes.
He wrote
of course.
an article on this in, it's on the AIER website. I think this was back in February or probably March, maybe around March. He wrote an article on this very issue, and Richard was saying, sorry?
Go ahead.
So Richard was saying the reason why inflation had not picked up despite all this massive increase in money supply is because of the fact that the banks were not lending any money. They were just keeping all these excess reserves, sort of just earning interest, not really putting it out into the economy. Now I think that has since changed, but I recall that article by Richard Salzman on that issue.
Yeah, well, first of all, what Jim is saying, and I think by implication what Richard was writing is basically all wrong. There's an obsession with this excess reserve thing. Forget it. It's just noise. You have to look at M2 and M4. What was happening? They weren't growing. What you said is wrong. We had the Great Recession. The Great Recession lasted for a very long time. And it lasted for a long time. And nominal GDP did not grow very fast. And inflation was way below the inflation target of 2%, because precisely the money supply was not growing very fast. Now, the question is, why? And of course, most people just get their feet all tangled up and have the thing completely wrong. What happened, the Great Recession started, the housing bubble collapsed, and of course we had Lehman went under, and we start a financial crisis, and at that time, coincidentally, Basel III came into effect, which increased the capital asset ratio for banks, and of course, to meet the capital asset ratio, that was one reason the loan credit expansion wasn't coming out of the banks. But the other thing that was going on is that you had something called the Dodd-Frank bill come in. And Dodd-Frank, remember, was basically an attack on banks and bankers, because the claim was in Washington, D.C., the narrative was that bankers were evil and banks were bad, and bankers caused the housing bubble and they caused the crisis. So to rein them in and put them in a straitjacket, Dodd-Frank was passed. So Basel III and Dodd-Frank in combination meant that bank money, which at the time was about 90% of M4. 90% of M4, most money is produced privately by banks, not by the Fed. The elephant in the room are commercial banks. The peanuts, the Fed is peanuts in the whole thing. And what happened? Bank money actually started going down. It was massively pro-cyclical due to these tighter regulations and capital requirements and so forth. So the bank money, the elephant in the room, starts going down as we're going into economic slump, massively pro-cyclical. So the Fed started quantitative easing. They did it 3 times. Fortunately, if the Fed had not done quantitative easing and increased the state money component, the state money component of broad money went from about 10% to a little over 20% of total broad money. If that hadn't happened, we would have had a Great Depression. We would not have had a Great Recession. We would have had a Great Depression. Now, most people, especially hard money types, gold bugs and so forth, they don't understand any of this. Remember, they said we were going to have a hyperinflation. The first time they did quantitative easing and the balance sheet of the Fed started to increase, oh, we're going to have a hyperinflation. Nonsense. The broad money, M4, was never growing beyond about 5% per annum during that period. It was growing way below the golden growth rate. Remember, I said the golden growth rate more or less around 7%. And the actual money supply, M4, was only growing, 4.5%, 5% during all of this period. So that explains why nominal GDP never grew very fast. It explains why the real GDP was in a pretty much of a funk. And it also explains why inflation was so low. So all of this BS about excess reserves and paying interest on reserves, it's just people fooling around and not knowing what they're talking about, honestly. It's very annoying for me to watch it because, again, 95% of what you read is either wrong or irrelevant. and this is a wrong conversation because your first statement that Jim made is wrong. And M2 never was growing very fast. And the Saltzman thing was just irrelevant because it is irrelevant. It has nothing to do with really what was going on.
Wow. Okay. So really you're saying that M4, so M2 should almost be ignored. You really need to look at M4.
Well, M4, I did say when we started, M4 is the best measure, but M2 was never really growing very fast either. M2 never grew fast, and M4 certainly was not growing fast. And Divisia M4 is what you should be looking at anyway if you really want to get if you want the most accurate metric that is related to nominal GDP growth, you look at M4. That's the broadest measure and the most accurate metric. And if you don't think it's accurate, think Paul Volcker in 1981, 82, and so forth. If he would have been, and even looking at M2, and he was looking at M2, but if he looked at Divisia M2, the weighted one, it would have shown him that, man, he had really slammed on the brakes way too hard, and he would have realized that, and we would have avoided probably at least one of those recessions, if not both.
So what do you know roughly what M4 has been growing at over, say, the past year or so?
About the same as M2. The growth rates are in fact about now they're actually about the same. And the reason for that, by the way, is that interest rates are so low. If interest rates were a lot higher, you'd get very different growth rates in M4 and M2.
Wow.
Divisia as opposed to simple sum measures of M2 and M4.
So the term divisia, just so everybody is clear, that basically means the weighting of the components. Is that right?
Right. It gets into a fairly hairy thing. There are very few economists that understand and know how to do aggregation theory. As it turns out, I don't think there are any at the Fed. As I say, the guy is Barnett. William Barnett he's the man. He's the top man in the world on aggregation theory. But you get some over at the Bureau of Labor Statistics, they have a few people over there who are quite good with aggregation theory. But it happens, oddly enough, there are none at the Fed.
Wow. Okay. Okay, so we have another question from an attendee. This is from Lee Schooland. Lee, thanks so much for attending. Her question is, when an old Chinese lady on the street of Beijing says to you, China is much stronger than the US economically because we Chinese are holding huge amounts of US debt, how do you respond to that?
It is a fact, but it's one of those kind of irrelevant facts in a way. I think the most interesting thing going on in China, and the reason that they're in a better position than the United States, is that they have, they're basically following Milton Friedman as monetarist right now. They're the only large economy that has embraced orthodox monetarism, and their golden growth rate is a little over 11% M3 growth, and they're now growing less than that, but they have been since 2014 almost right on the target. Now they've tightened up because they're trying to deleverage the economy. So they have I think an excessively tight monetary policy, but in general, since 2014, they've been hitting the bullseye, and they have until very recently hit their inflation target at 3%, right on the money. So right now, China, I would say, is practicing the most stable and orthodox kind of monetary policy in the world, and of course that's why the yuan. People want to know, well, why does the yuan seem to get so strong? It's because we've been growing our money supply M2 the last 17 months at a little over 20%, and the Chinese have been growing their money supply at a little under 10%. So it doesn't take a genius to figure out that in relative terms they're tight and we're loose, and the yuan is strong relative to the dollar.
Mm-hmm. Okay, here's a follow-up question from Jim Lordeman. He just responded to his previous question. Jim has a follow-up question. Can you comment on El Salvador's making Bitcoin legal tender along with their dollarization that occurred years ago?
Yeah, so yeah, I can make a lot of comments on that because I was to some extent involved in that dollarization in 2001 in El Salvador, not as an official, but as a friend of and collaborator of Manuel Hines, who had been the finance minister from 1995 to 1999, but he was the architect, in fact, of their 2001 dollarization program. So they're dollarized, like Panama and like Ecuador. So now we have what I think is a completely nutty law that's been passed. It actually is a law that will come into effect in September, and that is that along with the US dollar, Bitcoin will be legal tender. And since we're in the Bastiat society, the bad part of this is that it's going to be forced tender. In other words, it isn't just legal tender for settling debts, but it will be forced on merchants. They will have to accept it, and that goes beyond even, that starts infringing on free choice and choice of currency and so forth. That's not even true for most legal tender laws. Do not apply at all to spot transactions. I mean, if a merchant tells you, no, I don't want to be paid in dollars, I want you to pay me in peanuts. If you don't have the peanuts, you're not going to be able to buy the shoes. That's not going to be the case in Ecuador. If this law actually is implemented, they would have to, the shoe merchant would have to take Bitcoins, whether they wanted to or not. They couldn't choose. They could choose either dollars or Bitcoin, but that's it.
Okay.
I think by the way, I think it's a very dangerous thing, and I think there's really are some black forces behind it. It's not logical at all. Why would any country, if they were dollarized, be adding Bitcoin into the picture and forcing people to use Bitcoin? People want greenbacks down there. There are only 2 ATMs that take Bitcoin and spit out dollars, and it costs you 8% as a transactions cost. So it's very expensive. So it's just a nutty idea.
So I've heard a lot of conflicting opinions about Bitcoin. Some people really believe in it. Some think it's just a big scam.
Jim, I've got somebody knocking at my door. Can you carry on while I answer the door?
Sure. Yeah, so my question is about Bitcoin and the fact that there's really very divergent opinions on Bitcoin. Some people really believe in it. Some people don't. Some people believe it's actually has its real value is actually zero. So wanted to get Dr. Hanke's opinion on that. We've got about 6 minutes left to go for our event. So if anyone has questions, please feel free to submit any questions that you might have. Just got another one from Lee. Thank you, Lee.
Yeah. Thanks.
Yeah, so what I wanted to get your thoughts on, I've just been hearing some wildly divergent opinions about Bitcoin. Some people really believe in it, that it's a wave of the future. Some people believe its real value is zero, that it's just a big scam. So I'm curious, what are your thoughts on, what's your opinion on Bitcoin?
Well, the fundamental value of Bitcoin is almost by definition zero, but the objective price in the market is, I haven't looked at it today, but it's not zero. So the objective price is zero. The fundamental, the objective price is whatever it is at some positive level. Actually, we can find that out. Price of Bitcoin.
The price
Yeah, down $36,349.64. That's the objective price in the market. The fundamental value is zero. Now, this is think of it this way. The algorithm that generates this thing, and you have a lot of Bitcoin evangelicals, and there are a lot of libertarians, by the way, that are that are all snowed and taken in by this, and who don't really understand what they're talking about. This is like a religion.
Yeah.
And there's a big aspect of kind of libertarian religion, evangelical. It's like, remember the preacher Billy Sunday? If you don't remember, you get a revival. You get in the big tent, and you have a, we're having a Bastiat Society meeting. We're in a revival. but at any rate, let's get real. The algorithm produces something that is called Bitcoin, and its supply function is totally inelastic. It's a vertical supply function. Eventually, it has very little, almost no flexibility in it, or certainly any positive slope. So what happens? Its design is fatally flawed in the sense that the only way for adjustments to occur in the market when subjective demands shift around is what? Price. That's the only thing that can change. You have an inelastic supply curve, a vertical supply curve. You've got a negatively sloped demand curve that intersects, so the scissors are there. And the reason it's so volatile, people don't understand. Its supply can't adjust to changes in demand. So a lot of people think that the fanatics that are involved, they say, oh, this is why the price is going to the moon. It's like having one piece of art, a unique piece of art. It's fixed. The supply is fixed forever. Well, that's great. As long as the demand keeps going up, the price is going to go to the moon for that piece of art, or for Bitcoin. But what happens when the demand dries up and tastes change? The price collapses. And in the case of Bitcoin, what's going to happen? It's a contestable market, and there'll be more cryptocurrency entrants into the market that will be superior to Bitcoin. And eventually, I think the demand will essentially dry up. I mean, now the only real use of Bitcoin is for illegal activity. That's how it's actually used. The other part, and what drives the price, it's a speculative asset. It's not a currency, and so the greater fool's theory is driving the thing.
Yeah.
I mean, this Steve buys the thing today because he's going to sell it to that Steve down in Arlington tomorrow at a lot higher price. That's what the speculation is.
Yeah. Yeah. Okay. So I think it's actually 2:15, so we need to wrap things up. I wanted to squeeze in one last question, because this is a follow-up question from Lee Schoolin. She's the one that asked the question about the Chinese debt. And I think Lee is interested in this because she is Chinese. She actually grew up in Mao's Cultural Revolution, and she's actually been a past speaker of mine at the Bastiat Society.
Well, so fortunately, she survived.
Yes, yes. And so she actually speaks on freedom, and what happened in China under Mao's rule. So anyway, her follow-up question is, she wants to know, how do you respond to the old Chinese lady on the street in Beijing? Because this is the Chinese mentality, and that is the reason most Chinese support the Chinese Communist Party, because they believe they're now economically superior to the United States.
Well, I mean, that number one, that's what Chairman Xi is. That's what the propaganda. So you can cherry pick all of these metrics and numbers, and whether it's their, they are the leaders in rare earth minerals. There's no question about it. And if you look at China, which I've looked at in quite some detail, they're the leaders, for example, in metallurgy, mining, and if you look at their and material sciences. Now, why is that? They're the leader because they've invested a tremendous amount in those areas, whether by accident or wisely, and their universities dominate in those fields, and they're the only fields that have any kind of international ranking. The Chinese universities are not good by international standards, but they're very good in mining, material science, and metallurgy. Now, so if I looked at those areas, I would say, yeah, they do dominate. There's no question about it. If you look at the production of magnets, they dominate. If you look at the production of rare earth minerals, they dominate. All these fields are all in the realm of mining, metallurgy, and material sciences. Or if you look at the pile of US dollar treasuries that they have. So that's a manipulation of grandma in China, which is exactly what the chairman wants to do. My view is that I think Deng, in the modern era, it's Deng that we want to look at, because who has done more for economic freedom, probably, and the reduction of poverty than maybe anyone in history? It's probably Deng. And Deng's December speech in 1979, when okay, they were going to have socialism with Chinese characteristics, or free, put it the other way around, free market with Chinese characteristics, whatever you want to call it. It's been the biggest liberalization program probably in the history of man. And so I would point to that as something that grandma should pay attention to, not these other statistics that Z is putting out. Unfortunately, Z is kind of putting the brakes on Deng. Deng has been swept into the dustbin of history. Z wants to become another Mao.
Yeah. Okay, well, I think we've run a little bit over, so I think we'll have to end things now. But Steve, I want to thank you. Really grateful for your time. Really enjoyed your all of your expert input on so many economic, financial issues. And I also want to thank all of our attendees for attending this Bastiat Society event. And so until our next event, so we'll sign off and have a good rest of the day.
Thank you, Steve. Good to see you.
Good to see you. Thank you.
Okay. Have a good weekend.
You too. Thanks.